Look at a stock chart, and it is easy to just see a collection of lines. But what you are actually watching is a real-time tug of war. On one side, the greed of buyers. On the other, the fear of sellers. Most people try to survive this chaos by relying on mathematical filters. They pull up moving averages, the MACD, or the RSI, hoping these popular indicators will signal the exact moment to enter a trade. The problem is that these tools are built on previous price points. Because they use past data as an input, they can only describe what has already happened. They are inherently lagging. By the time a lagging indicator flashes a signal to buy, the market move is often already over. The trader is left entering a position based on a signal that is effectively a ghost of the actual move. To navigate the market in real time, you have to strip away the delayed noise. You must learn to read the only leading indicator that exists, the raw price itself. This language begins with the smallest unit of market data, the individual candlestick. Every candle has two main components. The thick central rectangle is the body, representing the distance between the open and close. The thin lines on either end are the wicks, which track the highest and lowest prices reached during that time period. A candle with a large body and no wicks tells a story of total conviction. From the moment the price opened to the moment it closed, sellers were unable to mount a counterattack. It is a snapshot of pure upward pressure. This specific shape allows a trader to see buyer dominance frozen into a single block of data. Zooming out to a sequence of these candles reveals a foundational rule. Price never moves in a perfectly straight line. An uptrend is a jagged staircase. To maintain its strength, the market must consistently push to higher highs and pull back to higher lows. These downward corrections, or pullbacks, are usually caused by traders exiting their positions to take profits. The size of that pullback tells us exactly how much momentum remains in the move. We measure this momentum using Fibonacci ratios. The 0.382 line marks a shallow correction, where the market has only given back about a third of its recent gains. If the price stays above this line, it proves that the majority of traders are still holding their positions, because there is so little selling pressure to overcome. These shallow pullbacks often act as a springboard for the next sharp move higher. By measuring the depth of these dips, you can distinguish a minor pause for profit-taking from a total trend reversal. At the macro level, we apply the principle that history repeats itself. Markets respect horizontal zones, where the price has historically hit a ceiling, known as resistance, or found a floor, known as support. These zones mark the specific prices where large institutions and masses of traders are waiting to execute their orders, creating predictable battlegrounds on the chart. These levels also anchor the concept of mean reversion. When price swings too far from its historical average, the weight of these zones often pulls it back to the baseline. Mapping these macro zones creates an architectural blueprint, identifying where the major market wars will be fought before they even begin. Simply seeing these three levels is not enough. You must organize them using multi-timeframe analysis. The process begins on the 4-hour chart. This perspective lets you draw primary boundaries of support and resistance. Then zoom into the 15-minute chart. Spotting microcandles and pullbacks touching 4-hour boundaries align small moves with the major trend. This hierarchy filters out noise, preventing you from being fooled by a small upward move that is actually about to hit a massive historical resistance wall. Combining these three levels allows a trader to stop guessing and start building conditional stories. A Plan A scenario might look for price to drop into a historical support zone and produce a shallow, weak pullback, creating a high-probability entry for a buy order. Plan B prepares for the opposite. If the price breaks through a macro trend line with high momentum, the strategy shifts to a short position. This structured approach replaces the panic of chasing lagging signals with a clear map of market behavior. Mastering the mechanics of raw price action provides a structural understanding of the market, allowing you to execute trades with the confidence of an architect.